Picture this. You're standing at the edge of something big. And while most investors are chasing the same household names, pouring money into triple-digit stocks that barely move the needle, there's an entirely different opportunity hiding in plain sight. We're talking about stocks trading under $10 that have the potential to multiply your investment several times over before January 2026. These aren't speculative penny stocks or desperate gambles. These are real companies with real products, generating real revenue, and positioned at the intersection of some of the most explosive trends in technology and medicine. Today, I'm going to break down two carefully researched companies that meet this criteria, and I'll tell you exactly why they deserve your attention right now. Let's dive in. The biotechnology sector has always been a goldmine for patient investors who understand the game. When you invest in biotech, you're not just buying stock, you're buying into the future of medicine itself. The first company we need to talk about is Amicus Therapeutics, and it operates in the rare disease space. If you understand how rare disease treatments work, you'll understand why this opportunity is so compelling. Rare diseases affect relatively small patient populations, which means less competition, premium pricing power, and once you establish your therapy as the standard of care, you create an incredibly defensible moat around your business. Amicus Therapeutics has cracked the code with not one but two commercially approved therapies that are already generating substantial revenue. Their flagship product treats Fabry disease, a genetic disorder that affects the body's ability to break down a specific type of fat. What makes their approach revolutionary is that it's an oral medication, which means patients can take a pill at home rather than sitting in an infusion center for hours. This convenience factor drives incredible patient compliance and satisfaction. The numbers tell the story. In 2024, this therapy generated $458 million in revenue, representing an 18% increase year over year. They're currently serving approximately 2,700 Fabry disease patients globally, and the patient base continues expanding as more physicians recognize the benefits of this oral therapy over traditional enzyme replacement treatments. But here's where it gets really interesting. In November 2024, the company announced a major patent settlement with a generic manufacturer that secures market exclusivity for this blockbuster drug until January 2037. Let me repeat that, January 2037. That's over 12 years of protected revenue with no generic competition eating into their margins. For a biotech company, patent protection is everything, and they just locked down more than a decade of runway. Their second commercial product is a two-component treatment for late-onset Pompe disease, another rare genetic condition. This therapy launched in 2023 and is already showing explosive growth. In 2024, it generated $70 million in revenue while treating approximately 220 patients in its first full year of commercial launch. The growth trajectory here is stunning. In the third quarter of 2024 alone, this product saw a 58% increase from the previous quarter. They're expanding into new markets at a rapid pace, securing pricing and reimbursement agreements in Italy, Sweden, Switzerland, and the Czech Republic throughout late 2024 and early 2025. Now let's talk about the financial transformation happening at Amicus Therapeutics, because this is where the rubber meets the road for investors. For years, like most biotech companies, they were burning cash to develop their pipeline and launch their therapies. But something fundamental has shifted. In the third quarter of 2024, the company achieved something remarkable. They reported non-GAAP net income of $30.8 million, or 10 cents per share. They crossed the profitability threshold. For the full year 2024, they generated $528 million in total revenue, a 32% increase from the prior year. Their GAAP net loss for the year was $56 million, which represents a dramatic improvement from the $152 million loss in 2023. They're not just growing revenue, they're doing it with improving efficiency. The company's management has laid out an aggressive but achievable roadmap for the next few years. For 2025, they're projecting total revenue growth of 17 to 24% at constant exchange rates. The Fabry therapy is expected to grow 10 to 15%, while the Pompe therapy is projected to surge 65 to 85% as more patients gain access and more markets come online. But here's the kicker. Management has stated they anticipate reaching positive GAAP net income in the second half of 2025. This means the company will officially flip from cash-burning biotech to profitable pharmaceutical company. And they're not stopping there. The company has publicly stated they expect to surpass $1 billion in total sales by 2028. Think about what that means for a stock currently trading under $10. You're getting in on a company that's already profitable on a non-GAAP basis, about to become profitable on a GAAP basis, with two approved commercial therapies showing strong double-digit and triple-digit growth rates, with market exclusivity locked in for over a decade, and with a clear path to becoming a billion-dollar revenue company within 3 years. The company operates with a collaboration and license agreement with pharmaceutical giant GlaxoSmithKline to develop and commercialize their Fabry therapy globally. This partnership provides validation, resources, and global reach that most small biotech companies can only dream about. The company's cash position remains solid at $250 million as of December 31st, 2024, giving them plenty of runway to execute their growth plans without needing to raise dilutive capital. Free cash flow generation is improving, and as they scale their commercial operations, operating leverage will continue to expand margins. Analyst coverage on this stock has been increasingly bullish. According to recent data, 7 analysts covering the stock have an average rating of buy, with a 12-month price target around $30 per share. That represents nearly a 177% upside from current levels. Multiple investment banks have recently raised their price targets following the strong third quarter results and patent settlement announcement. Now, let's shift gears and talk about our second opportunity, Nokia Corporation, a Finnish telecommunications giant that's in the middle of a complete business transformation. While biotechnology offers explosive growth from new therapies, Nokia represents a different type of opportunity. It's a turnaround story in one of the most strategic industries on the planet, 5G telecommunications and network infrastructure. And the timing couldn't be better. Nokia has been around for decades, but don't let that fool you into thinking it's a stodgy old company. They're positioning themselves at the epicenter of three massive trends that are reshaping the global economy. First, the worldwide build-out of 5G networks, which is still in its early innings despite what you might think. Second, the explosion in data center infrastructure driven by artificial intelligence and cloud computing. And third, the race to build next generation optical networks that can handle exponentially growing data traffic. In February 2025, Nokia completed a transformational $2.3 billion acquisition of Infinera, a leading optical networking company. This wasn't just another corporate acquisition. This was a strategic masterstroke that positions them to dominate the optical networking space, which is becoming increasingly critical as AI workloads demand massive data transmission capabilities. The acquisition increased their scale in optical networks by 75% and immediately expanded their presence with hyperscale cloud customers like Microsoft, Google, and emerging AI infrastructure players. The company expects to realize over 200 million euros in net operating profit synergies from this deal by 2027, with the transaction projected to deliver over 10% earnings per share accretion by that same year. Let's talk about the 5G contract wins that are fueling growth across Nokia's mobile networks business. In late 2024 and throughout 2025, they've been on an absolute tear securing major deals. They won a 3-year contract with Telecom Italia that will make them the largest 5G supplier in that network, entirely at their Swedish competitor's expense. They signed a 4-year extension as the exclusive supplier of 5G radio access network and managed services for TNN in Denmark. They landed an 8-year multi-billion-pound 5G deal with the merged Vodafone 3 entity in the UK. They secured a major contract extension with T-Mobile US to expand 5G coverage across America. They won deals with Vodafone and Vodacom across Europe and Africa. These aren't small contracts. We're talking about multi-year, multi-billion-dollar agreements that provide reliable, recurring revenue streams and demonstrate that Nokia is winning in the most competitive telecom markets in the world. After losing ground to competitors in previous years, they're now taking back market share in Europe and gaining traction in North America. But the real game changer might be what's happening with artificial intelligence and data centers. In October 2025, NVIDIA, the undisputed leader in AI computing, announced a $1 billion strategic investment in Nokia to accelerate AI RAN innovation and lead the transition from 5G to 6G networks. Let that sink in. NVIDIA, which has its pick of any technology partner on the planet, chose Nokia to work with on the future of wireless networks. This partnership validates their technology leadership and opens up enormous opportunities in AI-driven network infrastructure. Nokia's third quarter 2025 results demonstrated the momentum building across their business. Net sales grew 12% year over year on a reported basis, with all business groups contributing to growth. Comparable operating profit came in at 435 million euros, significantly beating analyst expectations of around 340 million euros. The strong performance was driven by robust demand in optical networks, IP networks, and cloud services, with increasing customer interest in AI and data center solutions. Gross margins expanded substantially as the product mix improved and operational efficiencies kicked in. For the full year 2025, Nokia has maintained its outlook for comparable operating profit between 1.9 and 2.4 billion euros. And here's what's particularly encouraging. They're tracking toward the higher end of that range despite headwinds from currency fluctuations and tariff uncertainties. The company has been executing a rigorous cost savings program and has already achieved 500 million euros in run rate cost savings, with a target range of 800 million to 1.2 billion euros in total savings. The financial picture continues to strengthen. Nokia generated over 600 million euros in free cash flow in the third quarter of 2024 alone, and 2 billion euros year to date. Their net cash position stood at over 5 billion euros, giving them a fortress balance sheet to invest in growth initiatives, make strategic acquisitions, and return capital to shareholders through dividends and share buybacks. Speaking of shareholder returns, Nokia offers a dividend yield of approximately 3.7% at current prices, which provides income while you wait for the capital appreciation story to play out. Looking ahead, management has laid out strategic financial targets that show confidence in their transformation. By 2028, they're targeting annual comparable operating profit in the range of 2.7 to 3.2 billion euros, up from approximately 2 billion euros in the trailing 12 months. For their network infrastructure segment, which includes optical networks, IP networks, and fixed networks, they're targeting 6 to 8% net sales compound annual growth rate from 2025 through 2028, with optical and IP networks specifically expected to grow 10 to 12% annually. They're targeting network infrastructure operating margins of 13 to 17% by 2028, and mobile infrastructure gross margins of 48 to 50% by the same timeframe. Nokia has fundamentally repositioned itself from a traditional telecom equipment vendor to a technology innovation leader focused on 5G, optical networking, data center infrastructure, and cloud native network services. They're no longer just selling hardware to phone companies. They're providing critical infrastructure for the AI driven economy. Their customer base is diversifying beyond traditional telecom operators to include hyperscale cloud providers, data center operators, enterprises, and even defense contractors. The defense opportunity deserves special mention. As governments around the world prioritize secure, sovereign telecommunications infrastructure, Nokia has created a dedicated defense incubation unit and is winning contracts to provide secure 5G networks for military and critical infrastructure applications. Nokia has created a dedicated defense incubation unit and is winning contracts to provide secure 5G networks for military and critical infrastructure applications. This is a long-term growth vector that most investors aren't fully appreciating yet. So what's the investment thesis here? You're getting a globally recognized technology leader trading at a very reasonable valuation with improving profitability, strong free cash flow generation, major contract momentum across 5G and optical networks, strategic positioning in AI infrastructure through the NVIDIA partnership, significant operational leverage as revenues grow, a healthy dividend providing downside protection and multiple years of runway as 5G and data center buildouts continue globally. Analyst sentiment on the stock has turned decisively positive. The consensus rating is moderate buy, with most analysts raising their price targets following recent contract wins and earnings beats. Some analysts see potential for the stock to reach the $8 to $10 range over the next 12 to 18 months, representing 40 to 65% upside from current levels around $6. Now, let me be clear about something. These aren't risk-free investments. No stock is. Amicus Therapeutics still operates in a heavily regulated industry where clinical trial results and regulatory approvals matter enormously. They have a limited number of approved products, and any unexpected safety issues or competitive threats could impact growth. Nokia faces intense competition from well-capitalized rivals, operates in a capital-intensive industry, and is exposed to currency fluctuations and geopolitical risks. Both companies trade under $10, which means they can be more volatile than large-cap stocks. But here's what makes these opportunities so compelling right now. Both companies have already proven their business models work. They're generating substantial revenue. They're either profitable or on the cusp of profitability. They're growing at impressive rates. They have significant competitive advantages in their respective markets. They're positioned in industries with long-term secular tailwinds. And most importantly, they're trading at valuations that don't fully reflect their growth potential. The market hasn't fully priced in what these companies are becoming. As we head into 2026, I believe both Amicus Therapeutics and Nokia have the potential to deliver outsized returns for investors who get positioned now before the broader market catches on. Amicus could see its stock re-rate significantly as it achieves GAAP profitability and demonstrates the durability of its revenue streams. Nokia could see a sustained rally as 5G and data center contracts translate into accelerating revenue growth and margin expansion. Neither of these outcomes is guaranteed, but the risk-reward setup looks extremely favorable at current prices. When you find stocks under $10 with this combination of growth, profitability, competitive advantages, and catalysts ahead, you need to pay attention. That's the story on these two stocks under $10 that you should seriously consider buying heavy before January 2026. Do your own research, understand your risk tolerance, and make investment decisions that align with your financial goals. But if you're looking for opportunities that could potentially multiply your investment while most people are chasing overpriced momentum stocks, Amicus Therapeutics and Nokia deserve a very close look. Thanks for watching, and I'll see you in the next one.